In this section, I will show you how to calculate your taxable income and the thresholds for different tax rates in the UK. Taxable income is the portion of your income on which you pay income tax. To calculate your taxable income, you need to follow these 4 steps. Step 1. Work out your gross income. This is the total amount of money you receive from various sources, such as employment, self-employment, pensions, rental income, and taxable state benefits. You can find your gross income on your payslips, P60s, bank statements, or invoices. Step 2. Work out your personal allowance. This is the amount of income you can earn before you pay any income tax. For most people, the personal allowance for the tax year 2026/27 is £12,570. However, this may vary depending on your age, income level, and other factors. You can check your personal allowance on the Gov.UK website. Step 3. Work out your income tax-free schemes. These are payments or contributions that you make to certain schemes that reduce your taxable income. For example, if you pay into a pension scheme through your employer or by yourself, you can deduct the amount from your gross income. You can also deduct certain expenses that are related to your work or business, such as travel costs, equipment, or professional fees. You can find more information on income tax-free schemes on the Gov.UK website or on the Which? Website. Step 4. Work out your taxable income. This is the amount of income that is left after you subtract your personal allowance and your income tax-free schemes from your gross income. This is the figure that you use to determine which tax rate applies to you and how much tax you have to pay. To illustrate this process, let's look at an example. Suppose you have a gross income of £50,000 in the tax year 2026/27. You also pay £4,000 into a pension scheme and £2,000 for work-related expenses. Your personal allowance is £12,570. How do you calculate your taxable income? First, you subtract your personal allowance from your gross income. £50,000 to £12,570 equals £37,430. Next, you subtract your income tax-free schemes from this figure. £37,430 to £4,000, £2,000 equals £31,430. This is your taxable income for the year. You can then use this figure to find out which tax rate applies to you and how much tax you have to pay. The tax rates and thresholds for the tax year 2026/27 are as follows. The basic rate of 20% applies to taxable income up to £37,700. The higher rate of 40% applies to taxable income between £37,701 and £150,000. The additional rate of 45% applies to taxable income above £150,000. In our example, your taxable income of £31,430 falls within the basic rate band. This means that you pay 20% tax on your entire taxable income. Your tax bill for the year would be £31,430 x 20% equals £6,286. If your taxable income was higher or lower than this example, you might have to pay different rates of tax on different portions of your income. For example, if your taxable income was £45,000, you would pay 20% tax on the first £37,700 and 40% tax on the remaining £7,300. Your tax bill for the year would be £37,700 x 20% plus £7,300 x 40% equals £10,460. You can use online tools such as the Gov.UK Income Tax Calculator or the iCalculator Taxable Pay Calculator to estimate your taxable income and tax bill for the current or previous years. That's how you calculate your taxable income and the thresholds for different tax rates in the UK. I hope this section was helpful and informative for you. In the next section, I will show you some tips and tricks on how to avoid becoming a higher rate taxpayer in 2027. In this section, I will show you how to use tax reliefs, allowances and deductions to lower your taxable income in 2027. taxable income is the amount of money that you have to pay tax on after deducting your personal allowance and any other expenses that are allowed by the government. The lower your taxable income, the less tax you will pay. There are three main ways to reduce your taxable income: tax reliefs, allowances, and deductions. Let's look at each one in more detail. Tax reliefs are special provisions that allow you to pay less tax or no tax at all on certain types of income or expenditure. For example, if you contribute to a pension scheme, you can get tax relief on your contributions up to 100% of your annual earnings or £60,000, whichever is lower. This means that the government will add 20% to your pension pot if you are a basic rate taxpayer, 40% if you are a higher rate taxpayer, or 45% if you are an additional rate taxpayer. Another example of tax relief is the patent box, which allows you to pay a lower rate of corporation tax, 10%, on profits from patented inventions. Allowances are amounts of money that you can earn or receive tax-free. For example, the personal allowance is the amount of income that you do not have to pay tax on. In 2027, the standard personal allowance is £12,570. This means that if your income is below this amount, you will not pay any income tax at all. However, if your income is over £100,000, your personal allowance will be reduced by £1 for every £2 of income above this threshold. Other examples of allowances are the trading allowance and the property allowance, which let you earn up to £1,000 each from self-employment and property rental without paying tax. Deductions are expenses that you can subtract from your income before calculating your tax liability. For example, if you run a business, you can deduct the costs of running your business from your profits before tax. These costs include things like rent, wages, utilities, advertising, and so on. However, some expenses are not allowed for tax purposes, such as entertaining clients or personal use of business assets. Another example of deduction is capital allowance, which allows you to claim a percentage of the cost of buying assets for your business, such as equipment, machinery, or vehicles. By using these three methods, you can lower your taxable income and pay less tax in 2027. However, you should always check the eligibility criteria and the rules for each method before claiming them. You should also keep records and receipts of your income and expenses to support your claims. If you need more help or advice on how to use tax reliefs, allowances, and deductions to lower your taxable income in 2027, you can contact a professional accountant or a tax advisor. One of the best ways to avoid becoming a higher rate taxpayer is to invest your money in tax-efficient ways. This means using financial products that protect your investment returns from the taxman, or reduce the amount of tax you have to pay on your income or capital gains. In this section, I will explain some of the most popular and effective tax-efficient investments you can make in the UK. The first one is individual savings accounts, or ISAs. ISAs are accounts that let you save cash or invest in stocks and shares without paying any income tax or capital gains tax on the interest, dividends, or profits you earn. You can pay up to £20,000 into an ISA each tax year, and you can choose from different types of ISAs depending on your goals and risk appetite. For example, you can use a cash ISA for short-term savings, a stocks and shares ISA for long-term growth, a lifetime ISA for buying your first home or saving for retirement, or an innovative finance ISA for peer-to-peer lending. ISAs are very flexible and easy to use, and you can transfer money between them without losing your tax benefits. The second one is pensions. Pensions are long-term savings plans that help you build up a pot of money for your retirement. Pensions are very tax efficient because you get tax relief on the contributions you make, which means the government adds money to your pension based on your income tax rate. For example, if you are a basic rate taxpayer and you pay £80 into your pension, the government will add £20, making it £100. If you are a higher rate taxpayer and you pay £60 into your pension, the government will add £40, making it £100. You can pay up to 100% of your earnings or £40,000, whichever is lower, into your pension each year and get tax relief. You can also carry forward any unused allowance from the previous 3 years. When you retire, you can take 25% of your pension pot as a tax-free lump sum, and the rest as a taxable income. The third one is bonds. Bonds are loans that you make to governments or companies in exchange for a fixed rate of interest and the repayment of your capital at a certain date. Bonds are generally considered lower risk than stocks and shares, but they can still fluctuate in value depending on market conditions and the creditworthiness of the issuer. Bonds can be tax efficient if you invest in certain types of bonds that are exempt from income tax or capital gains tax. For example, you can invest in UK government bonds, also known as gilts, or UK corporate bonds with a maturity of more than 5 years without paying any income tax on the interest you receive. You can also invest in certain social impact bonds that support projects with positive social outcomes without paying any capital gains tax on the profits you make. These are just some of the ways you can invest your money in tax-efficient ways in the UK. By using these products wisely, you can reduce your taxable income, increase your investment returns, and avoid becoming a higher rate taxpayer in 2027.